To an economist type, to Draghi, Yellen, Clarida, Gali, Gertler, and the rest of you guys, what does this market turmoil signal? When you see the brutal moves in oil, what does it signal?
Well, it really says we're really in a multi-speed world. You know, the U.S. has a decent growth rate, perhaps 3%. You've got deflation in Japan, deflation risk in Europe. China is slowing. You've got both excess supply, falling demand for oil, and now you have technicals. So it's a very volatile mix right now. Big countries going in opposite directions, policies going in opposite directions.
Does market movement limit the degrees of freedom, the choice set that these different central bankers have? Is Janet Yellen glued to her Bloomberg terminal at the Fed?
I'm sure she consults it
Is that a shameless plug? Okay, I'm going to go home now.
We have no sound effect for shameless plug.
But I think the Fed is pretty clear that they do focus on global events to the extent they impact their outlook for the U.S. inflation or growth picture. At some level, decoupling is not feasible. If you get a global recession, the U.S. won't decouple.
You're not
obviously
calling a recession,
I am not, but I'm saying were we to get into that stage, you would not have decoupling. You also obviously have a very, very strong dollar that lowers inflation, lower commodity prices, lower inflation. So that challenges the Fed as they want to start thinking about hiking in a year when prices may be falling.
Vince, Piazza, the other thing that's moving obviously this morning is oil as it drops down below 46. You know, we keep asking you for a number at which things will really start to change, and you keep saying, we don't really know. I'm going back to the well.
Well, let's start here. Vince, will they change here? Does Chevron or Anadarko or others, do they change their behavior this morning?
So in Q1, what we're going to find is we're going to see the press releases, and we're going to get a flavor for what that capital spending is going to be like for 2015. Yeah, they are resetting their priorities around their higher return inventory. But even with CapEx cuts, you will still see the resiliency of output, right? As that price comes on down, you are resetting expectations. You're also resetting expectations from the services side as well. Those costs will come on down, and so therefore your break-even costs will come on down somewhat as well.
Yeah.
Break-even costs vary even within plays themselves. There is no one particular break-even point. There are many producers in the U.S. They operate all along this cost curve.
All right, so Rich, maybe not Chevron or Anadarko, but a lot of the smaller players are very highly levered, and we've already seen a big spike in junk yield. How worried are you about contagion that's happening, this cratering of oil spilling over into the broader markets?
Broader market. Well, I think the wild card right here is capital spending in the oil patch is going to be down. If it's down by a lot, that'll impact the overall GDP picture. But so far, that's not a major impact penciled in.
Okay, I want to bring this up today. And again, folks, on Bloomberg Radio, I'll tweet this out later. This is the New Zealand spread. Never a dull moment. New Zealand is the kiwi in the coal mine. And they went to a negative yield. The 10-year yield is lower than the 2-year yield in New Zealand. No one cares, except Professor Clarida.
Yeah.
I think they do, Clarida. This shows the distortions in your world now. It's an odd world.
Well, think about it this way. This morning I heard on the radio end that 5-year yields in Japan are now zero.
Yeah.
Indeed, on the bid side, they're negative. 2-year yields are negative in Europe. Inverted yield curves typically only occur, as you say in New Zealand, only occur in environments where you expect a recession. I'm not saying that we do, but clearly the multi-speed world we discussed a moment ago is impacting all asset prices and obviously has a huge impact on U.S. interest rates.
But we're looking at the multi-speed world. We tend to talk about, China, Japan, U.S., Europe. You know, that chart about the Kiwi inversion that Tom's pointing to, there are a couple of outlier economies, Sweden, Switzerland, New Zealand, which behave in different ways.
Sure. Oh, absolutely. Well, we're just trying to give broad generalities. Obviously, New Zealand exposed to what's going on in Asia, and obviously Sweden and Switzerland exposed to what's going on in the Eurozone. So, absolutely.
Rich, of course, another one of the big stories we're following this morning is the sell-off in the currencies of many so-called petro-states. The Russian ruble back above 65 this morning. Your former colleague, Bill Gross, had an interview with Barry Ritholtz, a 2-hour-long interview that you can hear on Bloomberg Radio this weekend. But in it, he said he is concerned that the sell-off in oil is going to affect the demand from these petro-states for buying U.S. treasuries.
Well, sure, because they have big foreign exchange reserves, but as they spend them to defend the currencies, that means that they have less available to hold on to treasuries. So there is some impact there, and I've looked at that and others have looked at it. So far, that effect is being swamped by the opposite effect, is people wanting to hold quality assets in a time of turmoil, thus 10-year treasury yields below.
Well, I love your use of the economic phrase swamp there, because it really shows the dynamics that we've got this morning.